Hello, Hardcore Finance Show listeners and viewers. We are back coming at you from not walking today, but with Alex. And you're supposed to complete my sentences, man. It was supposed to be like,
I thought you would say the next thing, but yeah. Alex and Shimon are not walking today because it's dreary and cold outside.
it's very cold. It's kind of a weird, wet fall day, and the markets are starting to crack. So
Mhm.
today we're recording. This is going to come out probably next week. So we're recording on Monday, October 3rd. It's 1 o'clock in the afternoon. Let's see what's happening with the markets. But there have been some interesting developments over the weekend. Shimon, would you like to take us to them?
Yeah, so basically over the weekend, we said for many episodes now that the Fed will keep hiking rates until something breaks. And we were wondering, what is that something? The big difference from now and 2008 is that we have more debt. So one of the things that could break is the debt. And then the other thing is like unemployment, because we're seeing now lots of industries are slowing down due to the higher rates. So over the weekend, we saw a bunch of financial institutions in Europe be very close to areas where, it's not very different from 2008. Now, we don't know how big the contagion is. I mean, in 2008, even the, government didn't know what the contagion is, but it's definitely not looking good for Credit Suisse, for example. And if they're in trouble, a bunch of other people are in trouble too. What do you think? What did you see, Alex?
So I think there's maybe three or four things. One, uh, Japan is having trouble with their currency. Two, England is having trouble with their currency. We could talk about those. Three, Credit Suisse, as you mentioned, is about to fail. It's a major international bank. Oh, and there's rumors of Deutsche Bank as well.
Mm-hmm.
Um, Four, today in the morning, the Wall Street Journal published that the UN is literally asking the Fed to stop hiking rates.
Although
Uh,
I'm reading the Wall Street Journal and it says a UN agency warns that further policy tightening risks a global economic downturn. Is like, does the Fed not know that?
so it's interesting. So the Fed has been on this spree of an envious spree, and the one that really pisses me off is Bullard. He
Hmm.
just comes off so cocky, and what I read in his background is doesn't have very little, if any, actual market experience. It's all academic. It's like
Hmm.
our model's this, our model's that. The Fed dot plots, which where they predict where the rates are going to be, the recession predictions, all the models have been false over and over and over and over and over. And many market participants were saying, "You're easing too much. You're easing too much." Mohammed like I always mess up his name. Arian. I don't know why. I love him. I love him. But I
Think
always
of
mess up his
German
name.
stuff when you think of him, even though he doesn't look German.
Mohammed El Arian. There we go. I don't know how that was German, but I got it. It worked. It
Aryan.
worked. El Arian. Got it. Uh, nice. He was saying all through 2021 how we're gonna crash. He's like, we're going too fast, and they're gonna hit the brakes too hard, and we're gonna crash. And he was right. He's been prescient about this for literally over a year. And as was Stan Druckenmiller, and listening to Stan Druckenmiller over the weekend or over last week at CNBC, he was talking to a special summit, basically saying how things, their base case is a recession 23, and not so far from the base case, a possibility is a deep depression. And I think it's because the whole UN thing, and I want to turn over to you, is when we increase rates, debt becomes more expensive, and and the dollar in this case, and I can explain why, it becomes stronger. When debt becomes more expensive and people have to pay debt globally denominated in US dollars, everyone starts making a rush, all emerging countries especially, start making a rush to sell their assets, whatever they, it's like the saying, sell what you must, not what you want, in order to get dollars, because they're short dollars, because their interest payments are coming up and they're skyrocketing, right? Or to roll over the debt is going to cost them more. So they're short dollars. They're running over and buying dollars, which puts further, which makes the dollar stronger. And so a global shortage of dollars plus increased rates, which makes savings more attractive, so holding on to dollars more attractive, investments harder to come by, deploying capital harder to come by. We have a virtuous cycle in the dollar. And when that happens, again, the debt payments, the interest payments, it's like if you have a credit card and you have to pay $500 a month. Well, now your interest went up. Now you have to pay 600 or more $1,000 a month for the exact same outstanding debt. It becomes, emerging markets become less and less solvent.
Yeah, I mean, think if you live in Turkey, you just got a contract with a Turkish company, you're super happy, you moved to Istanbul, great city, great food, and you have $50,000 of credit card debt that you carry from the US. That's a good
Student
way to
loans.
understand it. I mean, student loans are fixed interest rates sometimes, but credit card, right? It's like, and you've been paying your credit card and stuff, but then suddenly your salary, that was amazing. Let's say they offered you $300,000 per year to go to Turkey as a consultant, but guess what? They're paying it to you in liras. And so suddenly over the last year, your salary was cut in half. So like even if you make a lot of money, suddenly you can't make your credit card payments. Now, what happens when you can't make your credit card payments? If you only pay the minimum payment instead of the full interest rate charge, the bill just grows and grows and grows. And so many countries in Europe where we're waiting for this to turn around, but it's not going to turn around unless they do something. Like I just have like firsthand experience here. I have a private banker in Barcelona, and I have a bank account there in euros. And he's like, hey, you don't want to transfer the euros over to the US. You don't want to convert them to dollars because this is like the worst time in history to convert them. And I was like, maybe this is the worst time in history, but what tells me that a month from now won't be even worse? Like I just don't see in Europe what will turn around this situation. So if you're an emerging market and the US keeps increasing interest rates, what can you do? You literally cannot do anything. You're at your maximum tax collection. Now, historically, this has been, I really recommend Confessions of an Economic Hitman. It's an amazing book, basically showing how the IMF and all these like global banks and stuff take over third world countries and saddle them with dollarized debt. And by the way, the reason why the debt is dollarized is because they tell them, look, if you want to borrow in your own currency, you have to pay like 30% interest. But if you borrow in dollars, you can only pay like 4%, 5%, whatever, 8%. And so if you have a project, let's build a bunch of highways that are supposed to yield 12%, right? Then if you had to pay 30%, you just wouldn't do it. You wouldn't borrow the money. You would lose on that. But if you do it in dollars, you just assume that the currency will be stable. But what happens is people pressure the government for more and more freebies. And then the currency devalues because the only way for the government to give people stuff is to print money. And so then now it's really a spiral that's really, really hard to get out of. And what I wanted to say is like before we had two blocks. We had like the USSR and the US. So the US had like, a competitor. People could go to USSR. Now China, I don't think it's a competitor to the US. Like I don't think people can go to China for loans because they're also in a tough spot. Everybody's in a tough spot. It's not like the USSR was running a surplus and the US is running a deficit. No, everybody's running a deficit. So it's a really tough spot globally.
I love how you called Europe a developing country, first of all.
Well, no, I meant for the UN part, right? Because they kind of represent the developing. Yeah, Europe is not developing. I would never call them a developing country.
Europe is declining. They're declining continent. It's the opposite.
Listen, Europe,
They're not
I want you to succeed. I love Europe. I grew up visiting Europe every year. It's
You
beautiful.
grew up in Europe, more
Yeah.
or less. So
Like I mean, just like get your stuff together. Look at what Thatcher did. She had to literally, hoard coal because she knew the coal miners would strike once she broke up their labor union. But this is what allowed the UK to go from a crumbling economy that like people barely had any homes. They didn't own homes almost. It was all kind of government provided homes that like you got and like it was tied to your job. Suddenly after Thatcher, people started buying their homes and everything
by
started.
the way, there was a great 2 years ago, Raul Paul and Robert Breedlove recorded a podcast about this. They were talking about how the government subsidized these homes for the people, and basically what they did is it seemed good in the kind of on the outset, but they indebted all these people, and there's all
Mhm.
these people who started taking consumer debt, and the consumer debt started ballooning. So it's two sides to every coin, just like in the U.S. Like, yo, you can go to college now, but so many more people go to college. created this sort of debt bubble that we're still living through now.
Yeah, and I just wanted to say about the models, I don't think this can be modeled. Again, between the two of us, I think I took the most advanced, money markets and the Fed. It was almost like a PhD level course. Like they taught us how the Fed thinks. And like, first of all, the most incredible thing is they said money printing doesn't create inflation. Inflation expectations create inflation. And the Fed now is using this language. They basically say it's really important to crush inflations before inflation expectations, change. I'm like, come on, guys, what drives inflation expectations if not money printing? You know what I mean? It's like, it's almost like a chicken and an egg thing. You literally look at the difference in CPI. We printed 40% of our money over the last couple of years. Half of it is held outside of the US. Prices here should increase by 20%. Like third grade math. No, but like what's wrong with, I know it's much more complicated, but top line, nobody can explain how you can print money and not create inflation.
Monetary velocity.
I know, yeah, but why would that change? Like you need to have like a good reason for why. Every single time, like Milton Friedman said, inflation is always a monetary phenomenon. It doesn't mean it's an only monetary phenomenon. Like I heard a podcast with Stephanie Kelton. She mentioned it always comes when there's some kind of shortage of some kind of commodity. Okay, so now we have a shortage of energy. But like it wouldn't have happened without the printing of the money. We would have a shortage of energy, prices would go up, and then people would invest more in infrastructure and just like build it.
Yeah, listen, that's for sure. I think I don't necessarily agree it's just because of printing money. You can print money, sit on it. Let's say everybody gets a check and just goes into savings. There's no inflation from that. There's no debasement. There might be debasement, but there's no inflation.
Is it going to be asset price inflation or consumer price inflation? But my point is, you print money, prices are going to go up no matter what. I don't see, even if you sit on the money, because now what happens is you sit on the money, interest rates go down, right? That's what sitting on the money means. It means there's a lot of money waiting to be deployed, which means interest rates are low, which means asset prices go up. You take a mortgage with a lower percentage, you can afford
you either use the cash or you create debt. Yeah, you create money. It's hard for me to argue against this because there's a lot of logic. But I do believe expectations change behavior. So while interest rates can go down and asset prices can go up, if people are saying, "Holy cow, my potatoes are going to cost twice as much tomorrow. I'm going to go buy them today." You have a flood of this huge demand that's coming into the market for various goods. And we've seen this during COVID, right? You're saying what changed? Well, COVID changed. It was a major shock to the system. First, we had goods inflation. Right now, we have services inflation, and hopefully it comes out. So people went all rushed buy goods, and they all went to travel. Now they're all going to get services because they can get out. And when that clears, we should come to a steady state. So the last thing to start clearing is rents right now, real estate, home prices. Once that clears, some people are saying, "Hey, look, Fed, stop looking backwards at CPI and core and PCE, and go look forwards. Look at like the PMI index, ISM indices, and housing starts, housing sales, right? Those are all rolling over. I think that's what's really, really important here.
Yeah, although housing is a little bit tricky because I heard an interesting analysis that it's like you should really look at square foot per person, not like housing units per person, because what happens is like people can downsize and then sometimes the price, doesn't go down evenly across all, housing types. But yeah, if you have a one bedroom, it's probably the price is going to go up and now go down because it's hard to move from a one bedroom down to the studio. But another thing that I wanted to just say about the whole UN thing, it's very dangerous when debt breaks, because when equity breaks, that's what we spoke about over the weekend. When equity breaks, all it means is like, your company is valued at a lower amount. But if debt breaks, if suddenly you have to pay a much, much higher monthly payment when you roll over your debt means you have to fire people. Like that affects your cash flow. So debt affects the company's cash flow versus equity. It also affects the cash flow because like you can't like print equities and sell them in the market and stuff and get the same price. But I would say debt is much more dangerous, and that's what I'm hearing. I'm not a debt expert. It's probably the part I know least about in the markets, but I'm hearing that like it's just more and more things are breaking, like the swap lines, for example, in the UK that happened over the weekend. Different like pension funds that cannot, basically what pension funds do is they insure themselves in case the growth isn't as fast. And so now the insurance is super expensive, so they can't generate the yield. It's a bad situation. But it's basically what we predicted, that they'll have to pivot at some time. When do you think the Fed will pivot, and how would that pivot look like in your
I'm
opinion?
nervous. I'm nervous. Not going to be anytime soon. More. I mean, I hope they do. Right. But again, Muhammad Al Arian, ooh, got it right. Talked about. He's like he had a very. It was yesterday and over the weekend, Friday. He's like, look, you want everyone wishing for a Fed pivot. Be careful what you wish for, because they're going to pivot only when something really breaks. When something breaks, everyone hurts. Look, if we start seeing banks go under credit freezing is what happened in 2008. That's very, that's catastrophically bad. That's not just very bad, it's catastrophic. I agree with you, and this is the credit markets, right? It's the lifeblood of business, being able to borrow in order to invest, especially in capital heavy industries. I don't know. I hope they pause by the year end. Pause.
I'll show you why I think the pivot is kind of close. And I heard a podcast where it kind of made sense to me, which is basically, and again, this is not my analysis. I'm not a political analyst, but they basically said, look, Biden pretty much gave up on the midterms. And so what he wants to do is just front load as much pain as possible. So then into the 2024 election, which is what actually matters, because like he can kind of veto stuff. You know, there's many things you can do if you lose on the midterms. But if you lose both the midterms and the presidency, then like the Republicans will start like taking over many things. And so he wants to front load the pain. And then into 2024, kind of late 23, early 24, start easing. And then the other thing is many times the stock market bottoms way, way, way before the GDP actually starts growing. So I saw.
Wait, sorry, I want to clarify. Is your soon is late 2023? That's soon?
That's what the podcast said. That basically, I don't know. To tell you the truth, I'm not a political. Yes, it could be. It could be end of. I'm willing to bet a lot of money that towards the presidential election, we will be not too far from like all-time highs. So we can still be under all-time highs, but it won't be like 60% below all-time highs in like September next year. So a year from now, I'm pretty sure that will be higher than today. And the reason is also like what I wanted to say, the stock market bottoms out way, way, way before the recession deepens to the pit and then starts climbing up. Like in 2008, I don't remember, it was like 18 months or 16 months or something before the economy started growing again. Like it was shrinking, stagnating a little bit, and then started growing. The stock market had bottomed like a year before. And what I wanted to share here is this, let's see if I can find this tab. My favorite tab that I always show on this podcast is like, this is the NASDAQ. So you can see this is like the support line. We're way, way, way below the support line. And this hasn't happened too many times. It happened like, twice here in March of 2020, and again in 2018 when they were tightening. So all of these were like tightening of the monetary supply, basically 1, 2, 3, 4 times. And this is the 5th time. So I think they're close to pivot. They haven't historically let the line be below this red line for a very long period of time. That's just
yeah, look, I mean, I hope you're right. I mean, it's a very technical, but it could also go under, retest, and then keep falling, right? It doesn't have to stay under, over.
I'm just looking at the past. Like before, it hasn't stayed for very long. Like it could stay only a couple months below this line before it recovers. But hey, I was wrong on Bitcoin with the 200 or whatever, the 48-month moving average. We broke below it and we're still below it. So yeah, the past is definitely not indicative in the future, but I just think that the NASDAQ is a little bit more important than Bitcoin in terms of the global stage.
There's an interesting tweet that just came out by Liz Ann Saunders. She's the chief investment strategist of Charles Schwab. She posted a chart. See if I can actually show my screen here. I'll show my screen. We'll both screen share. Here we go. I'm going to screen share my whole screen and go here. Look at this. It's our studio. Look at this. Basically, chart shows the trajectory for core CPI based on various month-over-month change scenarios. So if we're losing 0.2% month-over-month, March 2023 we're below 3%. It's
Yeah,
pretty
this is
interesting.
fascinating.
Sorry?
This is fascinating. Yeah.
And this is the trajectory that we've seen already. So we're looking at 6 months from now to be below 3%. And this is what many bulls are saying. We're gonna see downside surprises in inflation.
I mean, I'm a big believer in this because I think, and this is Kathy Wood's thesis, and we should really touch up on Elon Musk's AI day that happened also over the weekend,
Yes.
which is basically all the models, right? First of all, we haven't had a situation like today with 300% global debt to GDP, good unemployment, and terrible growth. Like, we haven't seen that trifecta. So I would just claim that previous models have not been in this territory. So we don't know if they'll hold. Then the other thing is Elon Musk was showing a robot, and the robot was kind of wobbly, but he was like optimizing the robot for displacing factory workers, not for defense like Boston Dynamics, not like all these like very, very expensive, very sophisticated robots that other people are building. He's trying to manufacture like 10 million of them over the next like decade to like replace, to get to a price point of $20,000, $30,000 per robot. Now think about it. That's a 1 year salary for someone. And you can just like pay it once and you get a worker that, works nonstop 7 days a week. And so how do you, look at this deflationary thing and how do you take that into consideration when you project inflation going forward? I don't think anybody can. Like, I don't think anybody could predict the deflation that the internet would bring. Paul Krugman, right, famously said, it's not more useful than a fax machine. You can look at what happened to interest rates after the fax machine and after the internet. After the internet, interest rates fell like crazy because basically there was globalization. There was cheap capital that was deployed everywhere. Productivity went up. So that's kind of my hope, but it's hard for me to put a timeline on it because I don't know what else is rotten in the system, and we haven't seen like a clear break. Like, a clear break is like 80, in the 80s or like March of 2020, where it just falls by 10%.
With capitulation.
Yeah.
Yeah, that's serious capitulation. We haven't seen it. Retail investors have actually been holding up the market, which is, both good and bad. Well, definitely good and bad. Yeah, I'm nervous. Or I guess on one hand, it's like, come on, capitulation comes so we can move out of here. But things are starting to break. The increase in interest rates has been the most violent, the most drastic increase ever. Forget Volcker. Volcker doubled interest rates. We went from 0.5 to 3.5 right now and going up to 4.5. We 7x interest rates. Not doubled, 7x. Right? And so that is a serious increase. And England is the fifth biggest economy in the world. By the way, do you know the top four economies off the top of your head?
I know that California is number 5 if it were to be a country.
No, again. US,
Well, I would guess
China,
US, China, Japan,
not
and
Germany.
what?
Japan. I forgot about Japan.
Yeah, US, China, Japan, Germany, and
England.
yeah,
England.
yeah.
I wonder what the difference between Japan, top 10 GDP countries. Let's see what Germany versus Japan is. US is at this is as of 2022. Global PEO service. I don't know what that is. Top 15 countries by GDP in 2022. US, $21 trillion.
Mm-hmm.
20.9. China, guess how much China is?
16?
China. Nice. 14.7. Okay. Then Japan. What do you think Japan is?
Like 11?
5.
Oh, wow.
21, 15, 5.
Yeah.
Germany.
I don't know. We don't have to play this.
Germany is 3 point. No, this is good. 3.85. United Kingdom is 2.76.
I mean, look, Japan and Germany, it makes sense because Japan has like 3 times the population or something.
But it's interesting. In India, it's 2.66, even though it's like, India and China, 7 million people, 14.72 versus 2.66. Pretty drastic. Then France, then Italy. But yeah, US by itself is just a juggernaut in terms of, it's kind of nice. What's up? We're the US, mighty US. Do.
Yeah, no, it's true. And also like per capita, the thing is the difference between the US and China per capita is much bigger. So it's not only,
For
the
sure.
total.
Well, look, Shimon,
So
well,
yeah,
you know what we need to do? Go ahead.
no, I just wanted to say, let's just end with what did you think of Elon Musk's presentation? I want to hear your take on it.
Well, let's do a second one about Musk. Let's have a second show about this and how it's going to transform because it's exactly Kathy Woods and our thesis.
Yeah,
He's creating bots with plus he's creating the infrastructure of the future. That'll be the next thing. Telemetry, logistics, flight, mobility, geospatial recognition, currency or money with Bitcoin and Doge, communications with Starlink, robotics. I mean, chip making. He's creating an integrated system that people are completely sleeping on and thinking Tesla's a car company. He's literally just creating the rails of the future, and I think it's amazing. What did you
yeah.
think?
Yeah, I mean, at the end of the day, look, I don't like to bet against humanity. Like I've said many times in the show, and high commodity prices are basically a bet against humanity. High interest rates are a bet against humanity. So, long term, if you're young and not investment advice, but like I'm actually kind of happy. I'm 40 years old and I'm happy that this crash is happening now because it would have been much, much more painful if it happened when I was 50 years old. Like much more painful. So, and
Yeah.
also, I learned my lesson about having a little cash position of like 10 to 20% and just like constantly rebalance because you never know, right, what opportunities will come. And like not having cash just basically means you can't do anything.
Mhm. Totally agree.
Yeah.
Totally agree. All right, Shimon, until next time, we will talk about Elon Musk.
We will
Like
talk
us,
about Elon Musk.
yeah, we will. Like us, subscribe to us at Mr. Ibida, at Shimon Lazarov, at Hardcore Finance. We'll see you next time.
And have a great week, everybody.